You might have heard the word dividends being tossed around in business circles. But if you're new to the world of self-employment and running a limited company, you might not know exactly what a dividend is. So, what is a dividend, and how do they help you be more tax efficient? Dividends are payments made to company shareholders from the profits of a company after corporation tax has been accounted for. When operating your business as a limited company, the most tax efficient way of extracting money from your company is usually via dividends. What is a dividend? Well, if your limited company has made a profit, it can distribute these earnings to shareholders by way of a dividend. Profit is the money that the company has remaining after paying all business expenses and liabilities, plus any outstanding taxes, such as corporation tax and VAT. Now, it's important to remember that dividends cannot be counted as a business expense when calculating your corporation tax, and that it's actually illegal to pay a dividend if your company doesn't have sufficient profit after tax available to cover the dividend amount. Any retained profit in a limited company could have been accumulated over a number of years. So if the directors choose not to distribute any excess profits as dividends at the end of the company's accounting period, then the accumulated profit remains available to distribute at a later date. Usually, the most tax efficient way to pay yourself as a director is by taking a combination of a low salary and dividends from your limited company. The salary will be paid to you as a director in the same way as a regular employee. We've got an article that explains how it all works. How much should I take as a salary from my limited company? How does your company issue a dividend? Now, if you want to issue a dividend, then you need to hold a meeting of directors to declare the dividend. The meeting needs to be minuted and a record kept of it. Now, this is the case even if you're the sole director of your limited company, though it may then just be a case of issuing the correct paperwork. If you use a good online accounting system like Crunch, then it should usually take care of all of the admin for you. For each dividend payment your company makes, you need to issue a dividend voucher, and this shows the date the dividend is paid, your company name, the names of the shareholders being paid a dividend, and the amount of the dividend. You should give a copy of the voucher to all recipients of the dividend amount, and keep a copy for your company's records too. Dividends should usually be distributed according to the percentage of company shares owned by each shareholder. So, if you own half of the company's shares, you should then receive 50% of each dividend distribution. Understanding tax on dividends. Your company does not need to pay tax on any dividend payments it issues, but the shareholders may have to pay tax on the dividends they receive based on their personal circumstances, and this is done through an annual self-assessment. Running your business as a limited company can be a tax-efficient way to operate, as neither the company nor you as an employee will need to pay any national insurance contributions on dividends. If you take a higher salary than the relevant national insurance threshold, both employers and employees' national insurances would become payable. Many limited company owners do combine dividend payments with a low salary to operate their business and personal finances tax efficiently. Make sure to check out our article, How Much Should I Take as a Salary, for more information. Understanding the tax-free dividend allowance. Each year, every individual has a personal tax allowance, and on top of that, you also have a tax-free dividend allowance. Currently, this means you can earn up to £2,000 in dividends in the 21-22 and 2021 tax years before you pay any income tax on your dividends. Dividend tax rates. Once you've used up your personal allowance and the tax-free dividend allowance of £2,000, Any further dividends you receive from any source will be taxed. Now, the amount of personal tax you pay on income from dividends is based on your tax band, also known as your marginal rate. The rates of tax you pay are lower than the income tax rates, which is one of the reasons dividends are so tax efficient for limited company directors. The rates actually haven't changed for a number of years, and these are currently as follows. Basic rate taxpayers pay 7.5%, higher rate taxpayers pay 32.5%, and additional rate taxpayers pay 38.1%. Now, our knowledge article, which is linked in the video description, is always up to date with current dividend allowances and thresholds that you do need to be aware of. We also have our Crunch Personal Tax Estimator that you can use to estimate the amount of tax you should pay on your total earnings each year. Now, if you're not yet a Crunch client, we can make paying yourself tax efficiently easy, with all your HMRC payroll and dividend forms taken care of. Even better, you'll get all the support and advice you need, plus all of your company tax filings taken care of too. We can even prepare and file your annual self-assessment tax return. Find out more about our great value limited company accountancy packages